3 months ago, I opened up a new investing portfolio to publicly showcase every move I make. Since then, it is already up over 21%, which is over double what the S&P 500 has done, and I've only done that with 6 stocks. In this video, I plan to break down that portfolio, showcase every stock I own, why I own them, what I expect from the future, and how they've done so far. To give you a little background, I started this portfolio June 8th, 2025 as a college investor with one goal: document the entire process. Concentrate in world-class companies I believe are undervalued, invest weekly, and ignore the short-term noise. And so far, that approach has worked. I'm up over 21%, whereas the S&P 500 since June 8th is up about 9.5%. And I believe the main reason is my high concentration. I own only 6 stocks: ASML, Google, Amazon, Adobe, Nike, and AMD. Now I own 6 stocks, but 94% of my portfolio is held in just 4 companies. ASML and Google make up over 60% of my portfolio, and then Adobe and Amazon make up that other half of the 94%. The rest of the 8% is in Nike and AMD. I keep it this concentrated because I have high conviction for each stock I own, and I have confidence in my large allocations. Most of my 21% gain this year has come from 2 stocks, Google and ASML. These 2 stocks have been on an absolute tear lately. ASML is up over 24% this past month, and Google is up almost 45% over the past 3 months. My Google position is up over 42%, and my ASML position is up 24%. I've thought both of these companies have been misunderstood and undervalued for months, and now it's starting to pay off. While many investors were fearful, I kept buying. A perfect example was on August 5th when ASML dropped over 12%. The numbers look strong, but the CEO made a statement basically saying that growth was going to be hard to predict for 2026 because of tariffs and geopolitical tension, but that didn't shake my confidence. I trust my research, I kept buying week after week, and now it's starting to pay off. I'm glad I ignored the short-term noise and kept buying. And then I'm sure you guys have heard the bear case for Google over the past year, that ChatGPT is killing Google search and Google is failing to adapt. At the lows of the sentiment, Google is under $150 a share. But quarter after quarter, Google has proven that this is actually the complete opposite. They're getting stronger with AI, not just in search, but across their entire business. And in all honesty, it was not always easy holding this company through the tough times. I would get TikTok comment after TikTok comment saying that I'm done for holding Google and I'm gonna lose money. Safe to say, I'm glad I trusted my research and ignored the noise. My Google position in this portfolio is up over 42%. And then I actually hold some more Google in another portfolio, and that one's up over 50%. My high conviction has paid off. Now on to my third biggest position, Adobe. I hold about 18% of my overall portfolio in Adobe, and I'm up only about 3.5%. I started buying Adobe around mid-July, and I've been buying about every week since. This has been one of the most hated stocks I've seen over the past year. Over the past year, this company is down over 30%, and over the past 5 years, it's down over 25%. In all honesty, this has been a terrible investment lately. Even though the sentiment has been terrible, I've started to see more conversation around the stock. I believe part of this is due to Joseph Carlson, a popular investing YouTuber, made a video called 8 high-quality, undervalued companies, and Adobe was one of them. Since then, I've noticed more people on TikTok and X talking about Adobe, talking about, hey, this might actually be undervalued, and I think the market is making a mistake. Another YouTuber, Financial Education, has been buying this company for most of this year. So we've seen some popular and successful investors talk about Adobe or buy Adobe and say, hey, this company is way too undervalued and the market has it all wrong. Despite all of this, the company is still down 19% year to date. To me, Adobe's situation reminds me a lot of Google's situation. AI is killing the business. Specifically for Adobe, it's that generative AI will make them irrelevant. Instead of buying Adobe's products like Photoshop, editing photos on there, or generating your own images, you can now use much cheaper generative AI to edit these photos for you or generate images for you. So why would you go to Adobe? On the surface, this sounds completely fair, but they're missing Adobe's moat. What sets Adobe apart is 3 things: high switching costs, strong network effects as the industry standard, and deeply integrated end-to-end ecosystem. The main customers for Adobe are not you and I, it's all the businesses out there. For me, yeah, I could go use ChatGPT or some other AI to edit pictures for me, generate pictures for me, do whatever. Businesses need the reliability, the integration, and the golden standard Adobe products. And AI, it is not a threat, it's just an accelerant, like we saw with Google. Adobe's Firefly is commercially safe, it's fully integrated into Creative Cloud, Express, and Acrobat, and it's already being monetized. Just look at the numbers. Revenue continues to grow at a double-digit pace. Firefly has now generated over 29 billion AI images, which is up 40% quarter after quarter, Contract obligations continue to grow, and Adobe is buying back billions worth of shares. This is a world-class company priced like it's dead. This disconnect is exactly why I'm comfortable making Adobe one of my biggest positions. If you want a full deep dive on Adobe, more than what I just gave you, you can click this box in the corner and you'll find that deep dive. I expect big things over the next few years from this stock. Now on to stock number 4, Amazon. I hold about 14% of my portfolio in Amazon, and I'm up about 6.5%. This is a company I'm incredibly bullish on for the future. I actually recently made a short where I was asked if I could hold one company and only one for the next 5 years, what would it be? My answer was Amazon. Amazon has been a laggard. Year to date, it's only up 6%, roughly half the performance of the S&P 500. Over the past 5 years, it's up just 57%, while the market has nearly doubled. Compared to other big tech stocks like Meta, Google, Apple, Microsoft, they have completely underperformed. But I'm not buying Amazon for the past 5 years. I'm buying it for the next 5 years. My conviction comes down to two main things: AI and robotics. Amazon is evolving from just an online store to the most powerful infrastructure company on the planet. They are building the backbone of the modern economy. Right now, Amazon has over 1,000 AI projects running inside the business. On top of that, Amazon is executing robotics better than every other company on earth. They have over 1 million robots deployed across their fulfillment centers. These robots are driving down costs massively and speeding up delivery. Amazon continues to operate like it's the world's biggest startup. Even at its size, it continues to innovate at a level nobody else is. To me, AI and robotics is about to supercharge everything Amazon is doing, and that is why it is one of my highest conviction stocks over the next decade. Now to the last stock I will talk about: Nike. Nike takes up about 4.4% of my portfolio, and I'm up around 16%. The reason why it's a small position in this portfolio is because in my other portfolio, I've been buying Nike for the past 9 months. Don't let the small allocation fool you. I have high conviction for this company. Nike is considered a dead stock and a dead company to many people. From its 2021 highs, it is down over 60%. So what happened? Why is the stock down? It comes down to two things: terrible leadership and then high levels of inflation. Let me give you a quick rundown on both. So with the poor leadership, Nike had a CEO from 2020 to 2024 named John Donahoe. He had a tech background and he brought that tech background to Nike. The biggest mistake he made was going away too fast from retail stores and going all in on the Nike app. Because he wanted people to go on the Nike app, he would discount prices. So these retailers had to discount prices as well to try to get people to go in store and buy Nike stuff. So then he had to go down farther, retailers would go down farther, and he would keep going until the price was completely diluted and margins were terrible. This completely tore down Nike. There are many other things he did poorly, but that was the main one. If you want to learn the other ones, click this video up in this box. It'll take you to that video. But now I want to go into inflation and how that hurt Nike terribly. So in 2022, we know inflation levels were at a record level. What happens to a company like Nike during inflation? Nike's a unique brand. They're not completely high-end where their customers can afford everything in the world. And they're not a total bottom thing where everything's cheap. Nike's kind of in that middle upper level. So you could say Nike sells to the masses. So who's affected the most when inflation levels are high? The masses. The people that buy Nike. Why would I, someone in the masses, go buy new $200 Jordans or go buy a Nike sweatshirt for $80 when inflation is hurting me heavily? I would need to focus on necessities. If I want clothes, I'll go somewhere else cheaper. That mix of super poor leadership and bad inflation combined killed Nike. Well, luckily, Nike brought in someone who was with the company for over 30 years, starting in 1988, named Elliott Hill. Elliott Hill saw what made Nike great. He wasn't an outsider like John Donahoe, and he is getting this company back on track. I also highlight the things he's going to do to get this company back on track in this video in the corner. If you want to learn more about Nike and why it's one of my highest conviction stocks, you should go watch that video. Okay, so that is my portfolio as a college student over the past 3 months. I'm up about 21%, holding 6 stocks, 4 of them making up about 94% of my portfolio, and I'm excited to see how this portfolio does over the next 5 years. For me, yes, I'm very happy about 21% in 3 months, but that doesn't necessarily matter to me. I'm curious, how will I be in 5 years compared to the S&P 500? I'm a long-term investor looking to beat the market over my lifetime, not just 3 months. So let's see how I continue to do. I'll always be fully transparent on here. I'll tell you what stocks I think are a buy, what stocks I'm looking at, the stocks I actually do buy, and then if I have any losses or I have a bad year in the stock market, you're going to know about that. I'm not here to sugarcoat anything. I'm here to become a better investor and showcase my journey online. Nothing I said in this video should be taken as financial advice. I'm not a financial advisor. This is all for education purposes and showcasing my journey. If you like this video, I have many more on my channel like this one on the screen. I hope to see you back, and thanks for watching.